Hello and welcome to this session on buy-side participants. In this session, we will learn about hedge funds, PE funds, pension funds, mutual funds, and insurance companies. So let us begin with hedge funds. A hedge fund is an investment fund that can undertake a wider range of investment and trading activities than other fund, but which is generally only open to certain types of investors specified by regulators. In other words, a hedge fund is an investment vehicle and a business structure that pools capital from a number of investors and invests in securities and other instruments. The name hedge fund originated from the hedging techniques used by some of the first of these funds. As a class, hedge funds invest in a diverse range of assets, but they most commonly trade liquid securities on public markets. They also employ a wide variety of investment strategies and make use of techniques such as short selling and leverage. Hedge funds are administered by a professional management firm and often structured as a limited partnership, limited liability company, or a similar vehicle. The investors in a hedge fund are typically institutions such as pension funds, university endowments and foundations, or high net worth individuals who are considered to have the knowledge or resources to understand the nature of the funds. There are various approaches used by hedge funds. Provide liquidity. So hedge funds are important buy-side participants. Exploit inefficiencies. Various trading strategies undertaken by hedge funds exploit inefficiencies and help price discovery. Arbitrage. Hedge funds use a wide range of arbitrage strategies which reduce inefficiencies in pricing. Leverage. Hedge funds also use high leverage margin, and derivative products are used by hedge funds. On the other hand, the strategies used by hedge funds are absolute returns. Hedge funds look for absolute returns, which is the return generated in a stock over a given course of time. Alternative asset class. Hedge funds invest in alternate asset classes such as art, wine, and real estate as well. Market neutral. Hedge funds use hedging strategies to offset market risk. Moving on to the role of hedge funds in the buy side. Now, hedge funds create competitiveness. Hedge funds play a critical role in the financial markets, broadening the use of investment strategies, increasing the number of participating investors, and enlarging the pools of capital available. For investors, hedge funds can serve a risk management purpose since their returns are often not correlated to those in the equity and fixed income markets. Hedge funds also provide liquidity and help investors manage risk. Markets work best when investors draw on diverse sources of information and utilize different strategies and securities to manage or hedge against risks. Private investment companies provide valuable liquidity to financial markets in normal market conditions and especially during periods of stress. The sheer variety of investing strategies that hedge funds employ also strengthens capital markets, particularly by improving opportunities for price discovery. Short selling, for example, contributes to the market's process of finding correct prices. Also, they create opportunities and spur innovation. The ability to trade different securities simultaneously in several markets maximizes opportunities for returns, improves risk management, and spurs innovation in financial products, services, and strategies. And lastly, hedge funds unlock shareholders' value. Activist hedge funds work to increase shareholder value through their ownership of a company and demand for improvements in management and business strategy. The top hedge funds in India are Hudson Fairfax Group, which is into private equity, Avata Investment Management, which is also into private equity, India Deep Value Fund, which is into capital markets and real estate, Fair Value Capital, which is into event and traditional approach on investment, Monsoon Capital, which is into investments in Indian equities, Karma Capital Investments in Indian equities, Advent Capital, which is into precious metals and Indian equities, and Atlantis Asset Management, which is an Asian hedge fund. Did you know, as of 2009, hedge funds represented 1.1% of the total funds and assets held by financial institutions. But while the comparative contribution of hedge funds to the global financial institutions may be small, they are still worth quite a lot. As of June 2013, the estimated size of global hedge fund industry was 2.4 trillion US dollars. Now moving on to private equity funds. With the complexity of private equity and its recent growth, we think it is imperative you also understand private equity funds. A private equity fund is a collective investment scheme used for making investments in various equities and, to a lesser extent, debt securities, according to one of the investment strategies associated with private equity. Private equity consists of investors and funds that make investments directly into private companies or conduct buyouts of public companies that result in a delisting of public equity. Investment fund is raised with limited partners committing capital to the fund. Capital for private equity is raised from retail and institutional investors. PE funds are managed by a general partner, also known as GP, which is typically controlled by profit sharing partners of the firm and funded by entities called limited partners, also known as LPs. Now, LPs are typically other large institutional investment funds like state pension plans, university endowments, pooled retirement funds, insurance companies, and wealthy individuals. Private equity firm is also called LBO firm, buyout firm, or financial sponsor investment banks. Private equity can be broadly defined to include the following different forms of investment. Leveraged buyout. Now, leveraged buyout, also known as LBO, refers to the purchase of all or most of a company or a business unit by using equity from a small group of investors in combination with a significant amount of debt. The targets of LBOs are typically mature companies that generate strong operating cash flow. Growth capital. Growth capital typically refers to minority equity investments in mature companies that need capital to expand and restructure operations, finance an acquisition, or enter a new market without a change of control of the company. Mezzanine capital. Now, mezzanine capital refers to an investment in subordinated debt or preferred stock of a company without taking voting control of the company. Often, these securities have attached warrants or conversion rights into common stock. Next, we go to venture capital. Now, venture capital refers to equity investments in less mature, non-public companies to fund the launch, early development, or expansion of a business. Now, coming to the types of PE funds, they include mega funds, Mega funds are multi billion dollar funds that invest across all industries. Mega funds invest in mature companies with strong cash flows via leveraged buyouts. Examples of mega funds are Blackstone, KKR, Carlyle, TPG, etc. Now we come to middle market. Middle market funds include $500 million to $5 billion that invest within specific sectors or across all industries. In most cases, the fund invests in small to mid cap companies via equity commitments ranging from $25 million to $100 million. Examples for middle market funds are Advent International, Golden Gate, Avista Capital, HIG Capital, etc. Growth equity. Now, growth equity are funds that invest in earlier stage companies. Generally, growth equity invests in smaller targets via platform or build and buy investing. Examples for growth equity funds are Summit Partners, General Atlantic, TA Associates, etc. And next we come to sector specific. Sector specific funds that invest in one or two industries. Now, these funds are widely middle market, growth equity, or distressed. Examples of sector specific funds are Silver Lake in tech, Lone Star in financials or real estate, Cressy and Company in healthcare, Energy Capital Partners in power. Next, we come to financial institutions. Financial institutions are private equity subsidiaries that invest across all industries. Usually, financial institutions invest in mid-stage to mature companies with commitments ranging from $25 million to $1 billion, with more of a net income focus than other shops. Examples for financial institutions are Barclays, GE Capital, Goldman Sachs, and so on. Now, what is the role of private equity in the buy side? Let's find out. The first one is profit making. They typically identify promising companies that require additional financing to scale up staffing, nurture a new drug through clinical trials, expand manufacturing, or otherwise make significant investments. After providing the capital, private equity firms then seek to profit either from ongoing operations or by selling their stakes to downstream investors or to the investing public through an initial public offering. The investments also encourage the market positively. A private equity firm frequently purchases a controlling interest in the company. This enables the firm to take control of management and replace managers as needed with those with more experience running larger enterprises. The expertise can range from operations to finance and accounting to technical expertise. The company also benefits from the substantial industry contacts the new management can provide. Thereby, this research is useful for other investors in the market. The next function played by PE funds on the buy side is financing. The private equity firm can provide financial support for the company in a number of ways. The firm can take direct ownership of a majority or minority interest in the company. For example, if the company's owners want to raise capital but do not want to dilute their ownership's interest by issuing stock, they may seek out a private equity firm to provide mezzanine financing, a type of senior debt issue. Now, moving on to mutual funds. A mutual fund is a professionally managed trust that pools the savings of many investors and invests them in securities like stocks, bonds, short term money market instruments, and commodities such as precious metals. They are an open end investment company which combines funds of investors who have purchased shares in a diversified portfolio of securities. Each shareholder in the mutual fund participates proportionally based upon the number of shares owned in the gain or loss of the fund. Investment in securities are spread over a wide cross section of industries and sectors, reducing the risk of the portfolio. Equity instruments like shares are only a part of the securities held by mutual funds. Mutual funds also invest in debt securities which are relatively much safer. Mutual funds are mobilizers of saving of small investors in instruments like stock and money market. This helps investors to diversify their portfolio just by investing in suitable mutual funds. Let us study the structure of mutual funds. The structure of mutual funds begin with investors. The investors pool in their money together and invest in a mutual fund. The mutual fund appoints a fund manager who further invests the money in a wide range of securities. Now, sooner or later, these securities generate returns in the form of capital appreciation and dividends. These returns help increase the value of the mutual fund which is in turn returned back again to the investors. There are as many as different types of mutual funds, such as money market mutual funds, stock mutual funds, index mutual funds, bond mutual funds, load funds, and no load funds. Mutual funds play a multitude of roles on the buy side. They include diversification. Now, diversification means funds of many investors are pooled and used to purchase a variety of investments. Professional management. Mutual fund provides investors with the benefit of professional and expert management of their funds. The next is convenience. Mutual funds offer convenience to the investors through easy market access. Mutual funds offer investors an affordable way to diversify their investment portfolios. It allows investors the opportunity to have a financial stake in many different types of investments. Investment avenue. These investments include stocks, bonds, money markets, real estate, commodities, etc. Individually, an investor may be able to own stock in a few companies, a few bonds, and have money in the money market account. But participation in a mutual fund, however, allows the investor to have much greater exposure to each of these asset classes and thereby enables them to earn a reasonable return with better liquidity. Next, we come to pension funds. A pension fund is a fund established by an employer to facilitate and organize the investment of employees' retirement funds contributed by the employer and employees. The pension fund is a common asset pool meant to generate stable growth over the long term and provide pensions for employees when they reach the end of their working years and commence retirement. It is a scheme in which investment is done for future and the policyholder makes the payment in the form of premiums. The policyholder gets the accumulated amount after a agreed period of time. The pension funds have the ability to absorb and efficiently process information on capital market operations. They have a large size and thus benefit from economies of scale, which result in lower average cost for investors. The countervailing power of pension funds is often used to reduce transaction costs and custodial costs. There are many different ways to classify pension funds. They are public pension funds and private pension funds, ERISA pension funds and PBGC pension funds, underfunded pension funds and overfunded pension funds, defined benefit pension funds and contribution pension funds, and trustee pension funds, insured pension funds, and self directed pension funds. Now that you have seen the types of pension funds, let us know more about pension funds management. The pension fund administrators are the ones who take investment decisions. In some jurisdictions, pension fund management can be undertaken by asset management and insurance companies. Some management decisions may be the responsibility of board of trustees in some corporate organizations. Pension fund custodians are those who keep custody of pension funds. Custodial services may be provided by central banks in some jurisdictions. Now, in the UK, Pension Protection Fund provides compensation to contributors where employers become insolvent. Now, let us focus on the role of pension funds in the buy side. Pension funds promote growth generation of savings that leads to capital accumulation and hence promotes investment. It also transfers resources in favor of long-term assets which have significant impact on GDP growth. Shifting to long-term assets tend to reduce cost of capital and increase the availability of equity and long-term debt financing. Pension funds also increases capital investment and labor productivity. Pension funds focus on developing labor-intensive, low productivity informal sectors to a capital-intensive, high productivity formal sector. It looks after the availability of long-term financing and simplifies government deficit financing through the issuance and purchase of government securities. It helps in the development of capital market as increased demand for new investment outlets stimulate innovation and develop new long-term instruments. It also increases market integrity or transparency and corporate governance. It reinforces improved regulation and supervision of the market and its efficiency. Finally, we come to insurance companies. Insurance companies are important institutional investors. Insurance is the equitable transfer of the risk of a loss from one entity to another in exchange for payment. It is a form of risk management primarily used to hedge against the risk of a contingent, uncertain loss. Insurance companies intend to provide security to the household sector in terms of steady income to dependents after death or accident or income after retirement. In order to provide insurance against risk, insurance companies invest funds in the capital market. Now, as we can see, surplus funds comprise premiums which policyholders pay. They are capable of raising substantial amounts of equity. In modern times, portfolio theory and a greater acknowledgement of complex products and stringent regulation have boosted investment from insurance companies. Insurance companies assure safe and long term investment in the market, which helps them to generate steady income for those who depend on them. That's it for now. Thank you and goodbye.